Our next segment, we wrap the week. As we've talked every Friday, we do a segment called Wrap the Week. It's really focusing on the evolution of the markets over the last 7 trading days. I want to start with a poll, though. We always have a poll going on our StockCharts TV page. I encourage you to engage with that anytime you can. It's a great way to just have a conversation about the markets, give us some things to think about. What I asked all of you was, where does Tesla close on December 30th, 2020 with perfect foresight? What do you see? And just as a reminder, the time we asked it, Tesla around 442 here is where it closed around there on today on Friday. So we gave you above 750, between 500 and 750, between 250 and 500, or below 250. The majority wins so far. The majority answer, at least, we'll see who wins at the end of the year, but the majority answer is between 500 and 750. So that would be basically suggesting Tesla between now and year end breaks to new all-time highs and remains up in this range, or blows way past it and at least comes back, but ends sort of above the current previous high. A quarter of you said we're in the range now. It sort of chops around, backs and fills right around here. Only 5% said Tesla's going down significantly further than that. And 12% of you, actually, over 1 in 10, said above 750, which is that's another 50, 60% rise in the stock. So, it's interesting. That's the kind of question I think it's interesting to think about how you would be prepared for different scenarios if you own a stock like Tesla. If you're holding off, what would you want to see given those different scenarios? It's interesting. I think the real question is, if the market corrects meaningfully from here, what are the chances that a stock like Tesla could remain elevated and sort of remain in that 500 to 750 range if the S&P goes down another 10, 15, 20%? Again, not saying that's definitely going to happen, but it's an interesting exercise. And while I don't think technical analysis is about predicting the future 3.5 months out, and certainly don't ever think that that's what I'm suggesting, I think it helps to think about potential future paths and how your toolkit would deal with that, and what you might be looking for to confirm one of those scenarios might actually be playing out. So as we wrap the week, let's just look very quickly at where we finished the day here. As I mentioned, the S&P closing just below 3320. That's down just over 1% from Thursday's close. So Thursday and Friday, sort of a similar scheme where you had some selling, a little bit of a rally going into the close, but overall, certainly just the stepwise motion lower. We're going to look at some markets and stocks and those key 50-day moving averages. Mid caps and small caps down as well. Small caps actually outperformed. They were only down about 0.6% today, and the NASDAQ led on the way down 1.3%. Again, this is one of those days where stocks and the VIX, stocks and volatility, were all sort of down today, with the VIX around 26. Bonds closed weaker as well. They really spent most of the day just chipping their way lower, only about 1/3%, so not horrible. And 10-year yields creeping back up to around 70 basis points, just below that right now. Oil sort of chopped around and finished flat, but at times was a little higher. Gold also finished flat as well after opening pretty strong. So there are a lot of sort of movements in the second half of the day that sort of reshuffled things, but certainly continuing, I think, the themes that we've seen up until today. Very quickly, I want to hit on some sector themes, and we'll look at some stocks, and then we'll focus on the Mindful Investor Live chart list. It's worth noting the number 1 and 2 sectors today, healthcare and financials. Healthcare almost finished in the positive, finished just a little below zero, but holding up very, very well. We're going to look at Merck a little later, and you think about stocks like Merck and what they're doing versus stocks like Microsoft and technology rolling down almost 2% again today. Kind of interesting. The other thing, and again, I always caution people, don't think about a market direction. The market's going to go down, which means things like utilities and real estate, big, high dividend payers should probably do very well. Again, none of these things are happening in a volume. So while in general, that is the long-term relationship, Utes and real estate, actually the 2 worst sectors to get, actually beating technology on the way down. That changed a little bit going to the end. I think tech was sort of at the bottom of the list, but sort of being taken over by some of those more defensive sectors. Materials also fourth from the bottom, and we've talked about the XLB being one of the better longer-term charts, really breaking. It's consistently pounding way to new highs, making another 52-week closing high this week, but today sort of finished more lower. So sort of a mixed bag in terms of where sectors were. It wasn't a pure offense, one side, and defense, the others. It's really mixed, and I think it really confirms to me we're in a transition, and transitions are not clean, and they're not a day, it's not a moment. It's a process. This is one day among many. So let's look at some of the longer term trends and think about what they represent. I did want to spend just a few moments here talking about some of the key markets and the 50-day moving averages. One of the themes we're going to talk about is how a lot of these are starting to break down, especially from some of those FANG names, the leadership names. This is the XLK. As we talked about recently, the question is the XLK able to hold its previous support levels and able to hold the 50-day moving average? Today certainly feels like follow through to the downside. We've now closed below the 50-day moving average and want to see the beginning of next week if it continues lower. But all else being equal, this certainly speaks to the potential and the probability of further downside for technology before all this is said and done. I think that's a safe assumption from here. The RSI is holding just around 40. And again, if it breaks down through 40 going into next week, that would tell you a little bit about the strength of the downside momentum and the potential there. The relative strength line is just rolling over as well. And again, the trend overall has still remained fairly positive, but we're potentially putting in a lower peak and starting to break down below some previous support on the relative line as well. So really speaking to how things are rotating away. Looking at some of the individual names in here, we see Microsoft again now breaking down through its 50-day retesting and going down to the downside. Just going quickly, these aren't all in technology, obviously, but just the sort of the FANG trade. We have Amazon that broke down through the 50-day actually last week, and now we've arguably completely validated that breakdown. The last thing is the 2,900 level. That's the low from July. So now we're seeing the run up in July, this pullback, and that's where we're sort of testing support. Again, based on what I'm seeing, I think we'll see weakness rather than strength with a stock like Amazon here. Elsewhere in the FANG universe, we have Facebook breaking down. I guess have to go through all of these, but this is the general theme I think you're seeing here. This is the leadership that got us here. It's all rolling over. These are big mega cap stocks. So even while some stocks may be holding up okay, even on today, pretty much everything was down, but even on days where there's weakness in stocks in the S&P, it's the big mega cap names that a lot of times could be dragging things down. It's not necessarily a broad thing. So make sure you're looking at a lot of different places to confirm what we're seeing. Our weekly trend model, which we update at least once a week here, short-term turned bearish last week, and this is when we just started to sell off and traded below the 5-week exponential moving averages. Average. The medium-term indicator is the weekly PPO or the weekly MACD using the traditional settings. Not enough weakness to trigger that yet, but I'm not surprised because that usually would need a little bit more of a downside push. Last sell signal you got was back here in mid to late February. The long-term trend certainly still bullish, and I think that's fair based on where we've come from. You have to see a lot of pullback to register any sort of negativity from the long-term trend. So at this point, based on where we closed today, short-term bearish, medium-term still bullish, long-term still bullish as well. The daily chart of the S&P is certainly concerning here, and the question going into the end of this week was, are we able to hold above the ascending 50-day moving average, which again, a lot of traders, a lot of investors, a lot of systems use something like the 10-week moving average or the 50-day moving average as just a guidepost. If we're up, just very simply, if the stock's above its 50-day moving average, it's in an uptrend. If it's below, it's in a downtrend. Even that one simple thing can help you differentiate from uptrends to down. Make sure you're on the right side of things. Worth noting, the S&P now breaking down through its 50-day moving average for the first time since in April. And the last time it was above and then broke down here was at the February peak. So again, this does not look exactly like the February peak. Don't get me wrong. It's certainly not what I'm suggesting, but I am pointing out that we're breaking down through support, which certainly is characteristic of a bull market top. As we've talked about, I think the base case for me is we go down to this blue shaded area around 3,200. I think safe to say that's where I'll be looking, and also looking to see if the RSI remains around its current levels. The breadth picture has been negative for a while, so I don't mean to beat this any further, but just pointing out that we've had this bearish divergence with weakening breadth going into the peak here. The S&P breadth is still sort of holding neutrals, hasn't broken down while the other ones have. But again, across the cap tiers are certainly seeing some internal weakness. The little green bars here over the course of the last week, and this isn't updated for today just yet, but it's worth noting there have been stocks making new 52-week highs. I even ran a screen yesterday and had a good group of names. It wasn't a handful. It was a couple handfuls of stocks that were making new 52-week highs yesterday. So they're out there. I think it's a really good time to have a stock picker's mentality. And even if you see some weakness around. There are stocks that are they're going to set up pretty well, and it's just a question of finding them and where they're at and determining the risk reward scenarios. Another look at breadth is the percent of stock above their 50-day moving average, and I think this is a key one to note. It's interesting to see how we've had sort of another bearish divergence here as the market's gone above 3,400 into a peak just below 3,600. Less stocks recovered their 50-day moving average on the way back up, and we're down to around 60%. You know, with any of these things, the 50% line is just a base measure that I look at, and I usually look at with a percent above their 200-day, which if you think about it, that's another 200 points on the S&P. That's a pretty long way down, to be honest with you. And so we'd have to move pretty heavily to the downside for this to go below 50. But that for me would be the, okay, things can get a lot more painful from here. You'd have to break down through that first, and we're nowhere near it. So it's certainly not the end of the world just yet. We hit on sentiment yesterday, so if you missed that, go back to our replay on our YouTube channel. You can see some of the comments on the AAII survey and the name active investment managers positioning. In terms of ratios, the ratio of cap-weighted consumer discretionary versus staples sort of rolling over, but the equal-weighted breaking up. And what that tells you is Amazon is looking weaker relative to the rest of the space, and that's what's dragging the cap-weighted ratio a little further down. On an equal-weighted basis, essentially that's telling you there are better stock-picking opportunities within consumer discretionary versus consumer staples, all else being equal. The semiconductors, we actually have a question in our mailbag about that, so I'm going to come back to that one. I did want to point out small caps have outperformed in the months of September, but again, I'm eyeing this, long term for the last 3 months. It's essentially been flat. I did also want to point out growth starting to break down versus value. There are a couple ways to look at this. The last time we broke below the 50-day moving average was back here in June. This is around the June peak, and from there we went right back to growth. So I think that's the question, and as we start to differentiate now versus sort of that June, July period, are we able to, do we see a similar thing where growth once again takes over? That tells you that the correction is shallow and leadership is reemerging right where it left off. If we see this ratio continue to go down, that tells you the growthy stuff that's gotten us here starting to weaken, and it might be a good opportunity to look at more value-oriented places like financials and other sectors you might have been ignoring for quite a while. Last chart I just wanted to get to is just to remind you, U.S. has been underperforming global stocks, and if you're not looking at sort of non-U.S. names, again, when this ratio turns down, it just tells me if you've been writing off your international exposure, you're giving, you're basically in a performance hole. You have the opportunity to outperform your U.S. holdings if you just think about where you might want to allocate outside the U.S. That is our wrap the week. And again, the general theme is stocks. We've talked about the ascending 50-day moving average, the S&P 500, and many of the larger names violating that today. And for me, that validates this short-term weaker thesis. I'd have to see a lot of improvement before I start to feel a little more optimistic about a resumption of the long-term uptrend. I think that's where we're at right now.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.